Capital investment makes up around 16% of aggregate demand. It has nothing to do with the stock market and investing in stocks and shares. When businesses or governments buy capital goods, which are things like factories or machinery, and this spending contributes to increasing the output of goods and services. Investing by the private sector is called private sector investment. It's by companies such as John Lewis, Dyson or BT. This makes up around 80% of all investments within the UK. And then public sector investment is investment by the government, typically on things like infrastructure such as building and roads, although the private sector could also invest in these areas. The difference between gross and net investment is that gross investment is total capital spending, whereas net investment takes into account depreciation, which is that over time the value of an asset, for example a piece of machinery, will fall over time due to things like wear and tear. So why do businesses invest in capital? One of the main aims for a business is to make profits. Investing in capital goods such as machinery allows the production to increase to meet consumer demand and ultimately increase the business's profits. Another reason would be to improve efficiency through investing in innovative technology, allowing the business to keep its costs low and also remain competitive. Finally, perhaps investing in capital and increasing production may allow the business to reach a level which allows them to exploit economies of scale. This is when the unit cost of production begins to fall. What affects capital investment? The real interest rate is one factor. When interest rates are high, so is the cost of borrowing, which reduces the expected rate of return for businesses, as it's now more costly to borrow to invest in capital goods. The growth in demand is also another factor, as when consumer confidence is high, usually when the economy is booming, investment in capital goods also increases, as businesses want to meet the extra demand by consumers and increase their profits. If corporate tax was to fall, companies would have more profits left over after tax. Therefore, the incentive to invest in capital goods would also increase. The level of technological change within a particular market would also affect capital investment. For example, the market for smartphones is constantly evolving, and businesses within this sector need to continuously invest to keep up with technological change. Business confidence is also an important factor. During an economic downturn such as COVID-19, businesses are less likely to invest due to increased uncertainty.